So let me go ahead and introduce our guest for this evening. Obviously, Bruce Norris is an active investor and a hard money lender and a real estate educator with over 35 years of experience. He's been involved and recently updated this number. He's been involved in over 6,500 real estate transactions as a buyer, a seller, a builder, and a money partner in those experience under his belt. Many of us know and follow Bruce because he was the first one to research and forecast long-term real estate marketing trends and timing with the release of his California Comeback Report in 1997. And for many years, he's been the one who's been connecting the dots for so many of the investors in California with incredible accuracy, which has led many of us to do extremely well in real estate and achieve financial freedom. Over the years, Bruce, obviously not just with the clubs here in California, but he's also been a highly sought after writer and speaker for some of the largest and most influential real estate and mortgage associations across the country. And he's been a voice at the table with FHA and Fannie Mae government officials, where he's discussed market solutions, insights, and things that are impacting homeowners and investors alike. We really appreciate him advocating on behalf of us as well. So I've also enjoyed listening to your podcast over the years and watching you interview some of the top minds in real estate, both on your podcast, your radio show, and of course at your annual I Survived real estate charity event. So even though Bruce now lives in Florida, he's never far from our minds here in California. Welcome back to LA South RIA, Bruce Norris.
Thank you, Lisa,
And
very much.
thank you. Thank you for being here. Craig Evans, this is the first time we get to introduce you here at LA South RIA. Craig has been a serial entrepreneur, and over the years, he's successfully grown multiple companies into quality brands by focusing on value at every facet of the business. He's the owner of Douglas Brook Homes, Trinity Building and Design, DBL Capital Real Estate Fund, which is an open-ended private real estate investment fund that some of you may already be familiar with. Their goal is to positively impact workforce housing crisis in the United States, which we know is significant, and you invest in high quality and affordable communities. But after partnering together for many years with the Norris Group, DBL Unlimited acquired the Norris Group and its legacy of exceptional quality and ethics in 2024. And that's how we've started to get to know you as well, Craig. Craig brings to DBL Unlimited nearly 30 years of construction experience, including residential, commercial, and municipal construction. He's a third-generation builder, and he's learned the business inside and out, starting all the way from laborer and now all the way up to CEO. We're very excited to have you here, especially to help shed some light for us on affordable housing in the U.S. and the builder's perspective on all of that as well. So thank you, gentlemen, for joining us tonight.
Our pleasure.
Thank you, Lisa.
Wonderful. Okay, so let's go ahead and get into our questions for the evening. Back to the moodometer. I just wanted to start there just because there's, like I said, there's so much to ask you about, but I am obviously we're moving outside of euphoric, so I wanted to know what you're thinking, feeling, where the mood is.
The last report that we wrote sort of dealt with that likelihood.
Yes.
And that's why we had a 1% mortgage rate or a lost decade. Because you would need a 1% mortgage rate to create space for your mood to get out of that euphoric zone and leave room for it to go up. There isn't room for it to go up. What's amazing is that you've been able to stay stationary in median price. And there's a lot of good reasons that's in place. One of which, about a third of California real estate is owned free and clear. And during the cycle that we had interest rates very low, another two-thirds of houses that have loans of 4% or less. So there's an enormous amount of inventory that has no way that somebody's going to lose their home on a payment or because they have no equity. So that's in place. So what a moodometer does is calibrate what percentage of income does it take to buy a house. And on the opposite end of that, what is the affordability rate in California? So historically, with legitimate lending standards, 17% affordability is the lowest number that's been reached. And then you're just done. You can't get a yes answer from a lender because you don't qualify. The only time it really sunk way below that was when you didn't have to tell the truth to get a loan in 2005 and 6. It went down to 12 or 13 and we paid a big price for that. So affordability right now is at 16. It basically says you're done. If you're a seller in California, it's interesting. You might have a different experience than a seller in Florida, but I wouldn't think you have tons of competition buying houses in California because there's just literally no place for the price to go. The monthly payment is absorbing so much of people's income that you've just reached a stalemate. So the only way to recover for that is a long-term decline, maybe of interest rates, along with you're slowly, gradually making more money, and you get those numbers to be a little more reasonable. But that's not happening overnight. And that's why California is pretty much done with price. I think you guys ought to be celebrating you don't have a price crunch because you're not going to have foreclosures and you need foreclosures.
Before we jump back to California, I actually want to ask how that differs, maybe to both of you, how that differs between what you're seeing here in California versus what you're seeing in Florida. And, if you only read the sound bites of the Florida market, oh, it's all going to hell. But we know that that's not really the case, that obviously there is some price compression there, but it's not falling through the sky like the internet would have you believe. So would you mind sharing a little bit of difference between what you're seeing in the Florida market versus California?
Okay, I'll go first and then I'll let Craig talk about that. Yeah, there's one thing about it's interesting. You go on YouTube and the sound bites for Florida are amazing, but what they all do is use percentages.
Right.
So I'll give you an example. The real stats for Florida, um, of course, I wrote them down. I can't find them, but I pretty much know them by heart. The percentage of foreclosures in the marketplace that you need for price damage has to exceed like 35% of the closings. That's California's story. Okay. And it gets terrible if it's over 50%. So Florida's in this terrible market where foreclosures and short sales do not add up to 1% of all the closings. Not 1%. If you're an appraiser, you completely ignore that comp. Has nothing to do with the value of somebody else's home. It just doesn't. Now, what you do have, and this could happen in California, but they don't build anything. In Florida, you build a lot of new homes with construction loans that have due dates. Uh-oh. Now add into that scenario, oh, here, I'll give you two category 4 or 5 hurricanes, and all of a sudden your labor screwed up, your cost of material screwed up, and you exceed that 12 months because you can't find anybody to come drywall your house. So now you have a motivated category of inventory that you didn't have before. So you don't need REOs in that scenario. You have a builder going, wow, I've got too many of this, okay, along with other people. Fortunately, that's a shorter lived process than a foreclosure process, where you have a third of your people losing their homes and their credit and their capacity to buy again. So this is a very different market. Florida is different in the sense that you have some price categories that have taken hits. The median price hasn't taken a hit, but there's category of houses that have. That just means there's too many of that. Okay.
Too many of that in that particular
That's right. Well,
geography.
I'll give you an example. 2 years ago, we have a home that's 2,170 square feet, really upgraded well. It would have closed at 715. Last month or last 6 weeks, we closed 4 of them at 560. Now, when I started building them, they were worth 560. Before I could get done, they were worth 715 because that's what happened to the market. So they're back where they were. It feels like a big loss, but it's where they were before. But too many of those houses exist at the same time. That's a challenge.
So it's a supply problem, and I would assume, well, I can't assume, I don't know for sure. Obviously, we have very few buyers in the market out here. I'm assuming it's sort of similar in that just a record low number of buyers in the market currently at a time where the supply happens to be higher proportionately in Florida, correct?
You have a higher proportion of say like you have month supply. But what is interesting is a lot of houses have no motivation other than I hope I sell. And then, okay, if it doesn't sell, well, so what? Go back to New York and live in my other home. And it's a different category. And again, the borrower is not in trouble in Florida either. Oh, that's just under 1%. They're not in trouble. They got mortgages that make their payment less than rent. So yeah, we just have to go through a time where you adjust the inventory to the volume. The moodometer also calibrates the urgency. Nobody's an urgent buyer right now. Nobody. Now, boy, in 2000, let's say in four or 2021, when you had something for sale, you had 10 offers by noon. I mean, you were like having lunch with your partner going, how big did the price get? Because that was a fact. Okay, well, guess what? That cycle returns when you have less inventory and more people. You just need two or three people want the same thing at the same time. Now we have two or three houses wanting the same buyer at the same time. And that's the negative.
Bruce, it's interesting. You're talking about the foreclosure. I just wrote a piece on this last Friday, and the foreclosure and short sale rate ratio in Fort Myers are well in Lee County right now. So that's Fort Myers, Cape Coral area is where it's 0.5%. So
Yeah,
it's a half a point, but that's only the ratio between what's currently listed and what actually closed over the last 12 months. If you take that with all the inventory, it's actually 0.00004%. So it's a misnomer that's out there right now. And
yeah,
interestingly, you were talking about it earlier, Bruce, with the amount of appreciation that came in the homes from 2021 up until June of last month, June of 25, we've had 70% appreciation. But when
that,
you
that
say,
has
okay, now
retained.
no, 70% appreciation. Let me back that up. So it'd really be up until about 12 months ago, 2021 up until about 12 months ago, 13 months ago, we saw 70% appreciation.
Okay,
Over the last 12 months, we've had right at about 10%, softening in the market.
right.
So the reality is, if you're looking from 2021 up until now, we're still up 60%.
Yeah.
So
And
the only people that are actually showing anything of a softening in their market is the people that bought in the last 12 months.
that's right.
Yeah,
And that's not a big,
they're not going to. Most of those people are not moving next week, so they may look underwater on paper, but they're not if they don't sell right now.
right.
Give it another 2 years, and they'll be right back in a good position.
Yeah, it's interesting when you go to YouTube and you can see how many voices want attention. Look at my site. And then they go, okay, well, gosh, foreclosures are up 200%.
12,000%.
Yeah, some ridiculous thing. And you go, okay, but it's not even 1% of the closings. It's completely meaningless. And I tell you the truth. See, that's why I love the fact that I went into looking at this data without any agenda. I wanted to know where to put my money. And I wanted to look at charts as realistically as I could. So that's I've debated plenty of PhDs in my time. I've got a high school diploma and like you said, a few thousand transactions under my belt that I wanted to know how to get my money back and maybe some more. And there was a time, the reason the first report got written, Aaron graduated from high school and I bought him a Honda Civic for 15.7 and 2 days later bought a three-bedroom house in Riverside for 13.3. And I just couldn't comprehend that. I was like, how could that happen? And so that's kicked off my attempt to look at the statistics. And so what's interesting is some of the questions are going to be asked. Okay, so interest rates decline. Well, there's a history of that, of interest rates declining at the end of a cycle where you've used up all your room. Does it have any impact on the upside? Not at all. It just doesn't. The mood isn't there. I mean, you'll make it technically more affordable. Will you drive volume to the buyer? No, not quite yet. No, that takes some time and progression. Um, what's interesting about interest rate hikes. So didn't we just go through an interest rate hike? I would say we went through 2.5 to what, 6.5? What's that a multiple of? Did we collapse? We went up 2.5 times in interest and nothing happened we didn't crash. So you can have interest rate hikes and you can still have stability and you can even have progression of price. So one other example, and this is the first chart that blew my mind. In 1974, interest rates were 7%, and in 1981, they were 16. During that journey of interest rates going from 7 to 16, you know what happened to prices in California? They tripled. They tripled when your interest rates doubled. So that's what's interesting. You have a fact there. You have to deal with that. Holy cow. How could that happen?
Well, I heard you say something, and I'm curious if you can just expand on that a little bit because you said at the end of a market cycle, the rates tend to go down. But I feel like we're in a position right now where the opposite would expect to happen, right? I'm looking at the 10-year, I'm going, there's no way, that's a lot more risky. I see inflation on the horizon. So I'm missing that part about how or when or where these rates are going to drop if we're really looking at an inflationary trajectory right now. Am I reading that wrong?
I think so. I kind of think so. I don't know that we're going to have, I think you're going to have some unemployment. So I think you're probably going to have a chance for interest rates to go down, but it's not the be all tell all that it's assumed to be. You need a lot of people interested in buying real estate, and right now there's not that group of buyers.
Mm.
The move up buyer is pretty stationary. So and I'll let Craig talk about this. The first time buyer wants in. You give them a 5% mortgage in this market, Craig won't be able to build houses fast enough because that's their shot. Okay. But if you got a 3% mortgage or a 2.5% mortgage, I'm going to stay. There's a lot of inventory that's just frozen. So, and that's been a saving grace too, because all that inventory that would have been for sale isn't coming on the market. It's not going to get foreclosed on because the payment's less than rent, but it's not going to be a competitor either. So this is a very unusual decade. When's the last time we had a 2.5% mortgage? Never.
Never.
Well, and Bruce, that's exactly what's happening. I mean, we're seeing that the first time home buyer market, that market's still moving in about 21, 22 days. You get up over $1 million, that market, we are getting multiple offers in that market. You get in that mid-price market of 5.5 to 7, and that's the market that's frozen right now. So it's an interesting play of where that market's sitting because of those factors.
I'll just mention too, we had about 18 months of interest rates going down. You got to 4%, you go, oh my God, never thought I'd see that. 3.5, oh, 3, 2.5. And during that journey, Home Depot was the busiest place in the world because people were going, wow, I can add a room to my house and not raise my payment. I can have the place I always wanted, my office and a pool, and my payment's the same. So people made permanent decisions. They have no intention of selling that home. A lot of inventory is in that category. I'm not going anywhere.
I want to shift gears here and talk a little bit about, and Craig, I'd love your thought on this because I think this is one of the things that some folks are having trouble wrapping their heads around with respect to housing inventory and then affordable inventory specifically. So we're hearing a lot about in your market specifically how there's just not the inventory is not there. We have this huge housing shortage. The country has a housing shortage. Can you talk a little bit more about that housing shortage and whether it is an affordability shortage per se or whether it is a true housing shortage?
That's a good question. I don't, And I think because we're in several markets, so of where we're at. I mean, I'm based here, but we're in several markets, and I think the biggest thing that we're seeing right now is actually an affordability crisis right now. I think there's a shortage on affordability. While there are the higher end market in most markets that we're looking at, there is maybe a little bit of a shortage there. There's not a shortage of, like Bruce has been talking about, there's not a shortage of homes in a mid-price market. That's a market that's frozen. The aspect of affordability, is there a shortage, or is it what is actually attainable from an affordability perspective? I think those are several of the things that's happening. But in the process of, again, affordability, if I look, let's just say, let's talk Florida, right? If we're talking Southwest Florida, if you're looking at the amount of homes that are classified in first-time home buyer positions, again, there's 39 to 40 days worth of inventory. When you look at the inventory as a whole, there's 7.5 months worth of inventory. So the affordable price market is really still moving, and there's not as much of that as we need right now. So I think that's a big component that we've got to look at as we're moving forward and moving through these types of shifts, is how do we create a better affordable product, whether it's fix and flips, whether it's brand new construction, whatever the product as an investor that you're working in, you've got to focus from an affordability, if that's your market. If you're focused in the high end, and I'm only wanting to deal in $1 million and up, or 3 million and up, or 10 million, whatever that market is, if that's your market, that's a different ballgame. But if you're looking at how do you take product and move product, or gain a portfolio that's going to turn consistent cash flow, affordability is always a good key. And right now, that's a push of how do you achieve affordability.
Well, and that's the question, right? I rehab houses, I own rentals, but I love rehabbing just because I love making something new. And obviously, in the type of work I do, there's not, I wouldn't say there's a whole bunch of efficiencies, because each house is a little bit custom, a little bit unique, things like that. So I don't have the same type of overhead, or the same type of structure that maybe a builder might have. But nevertheless, the cost of materials, the cost of labor is sky high. And then you add on to that insurance, and you add on to that, everything else. And I hear this scream generally from, we need more affordable housing. We need something that, people are feeling economic pressure all over the place. They need more affordable housing. Yet it's harder and harder and harder and harder to produce that. So in your own building and development business, how are you offsetting the two? Because I don't know if they go up at the same rate as they do out here, but how are you making things more affordable when all the inputs are rising?
Well, and that's been a tough component, and obviously part of that is a scale. It has been a lot harder for the smaller guy to compete, because if you can come in with scale and you can buy, like I had last Thursday, I had 60 properties come across my desk from a builder that had done a bunch of stuff, and so 60 doors that came across my desk to try to buy. If I'm buying them onesie twosie, there's really no discount on that. Going in and buying those at that volume, there was 30% discount on. That's a big number. So scale brings a lot of that, because at the end of the day, in my opinion, one of the things that's still driving this, and Bruce and I've talked about this since probably the first day we ever met, is one of the biggest things that's still driving that is the energy sector. The energy sector, since really about 2020, has just skyrocketed, and that's affecting and touching everything we do. Now you see it at the pump. You're able to get fuel a little bit cheaper now, but the reality is, it's still, if we go back to 2020, we're still almost 40% higher than what we were paying for fuel at the pump 5 years ago. When you look at how many things that touches, that's your average plumbing fixture is touched about 6 times by a cost of diesel fuel before it ever gets to the job site to be able to hold water. those things are real. So you've got to find the differences in your basis of how you're starting, and that's what we have to focus on as a builder, whether we're building from scratch or whether we're buying flips. Because in our fund, we buy properties and flip them, or fix them and hold them inside our fund. In that process, we've got to address that from a basis perspective. If we start upside down, we're never overcoming that. So that's one of the biggest aspects that we're looking at. We are seeing in different markets, there's some different nuances from a labor perspective that you're able to battle and play with a little bit. Again, partly because the last 5 years, it's been such a hard demand of labor. And now that it's starting to cool off, there is a little bit of the labor rush is starting to cool off where they're looking for work in many markets, not all, but many of the markets. So I think that's the biggest aspect is finding the ways to create affordability, and a lot of that starts with what's the basis that you've got going into the product. People are still, I think, paying too much for either starting a product or what they're paying for land or whatever that starting factor is. It's a lot of that goes back to basic economics. You can't overpay when you start.
Lisa, I'm just going to mention, I mean, what's one of the reasons California loses migration all the time is the price is higher by far. Your median price is twice of Florida.
Right.
So Florida has an awful lot of migration because it's got a lot of advantages, but it's the average price in the United States. If the US median and Florida median is pretty much right on the money. And so Florida is very attractive to people because of that. So we've had now Florida has its issues too. If you have a condo, if you live next to the condo that fell to the ground, that was a problem. So that caused all kinds of problems for the insurance and the reserves for fixing the condos that yours might happen next, that type of thing. So, all of that, I guess every place has its issues, but Florida's certainly been the winner of migration of people and money for the last, 6 years plus.
I definitely can see that. One other question I have regarding affordability, at least in the California market, I assume this applies everywhere. When I think about the end buyer or the person, the renter or the home buyer or whatnot, everybody has an amount of their income that they can allocate toward housing. And if insurance is rising, if maybe interest rates are rising, if energy and your utilities is rising, all of that is sort of eating into this fixed pie of income that you have that you can afford to spend on your house, on keeping the lights on in your home. And I'm wondering, because I can't think of a time, and maybe there has been, but I can't think of another time where we've had all of the inputs sort of rising at the same time. And I'm wondering how that may or may not affect value maybe in California over time. Because if all of the other things, when I think about PITI, right, and my I is increasing, or my T is increasing, right, that means my PI to make that same payment, my PI have to shrink somehow magically. And I'm just trying to figure out if we're going to see any kind of shift there, because if those costs continue to accelerate or increase, where can the prices go eventually?
I don't think they can go anywhere. I mean,
Okay.
that's the thing. That's what affordability number at 16 is telling you is you're done. And so is the other number that's so high, it's you're done. So a new person's not going to show up that market and go, I'll be fine spending 60% of my income on my payment because I can't do it. So I'm going to move to Florida or someplace like that. So there is an interesting journey. You asked, have we ever had this before? Yeah, we have. 74 to 80, the interest rates were different, but the ratios were the same. You started out at 7 or 7.5, got over 16. So that's a doubling of interest rates, but the affordability was so affordable when that thing started that you didn't get to 17 until you tripled in price. And then you started that repetitive scenario where, okay, you build up affordability back to 35 and then you go back down to 17, that type of thing. The problem is right now you're stuck at 16 without the tools that will get you to 30. You're not going to have a big increase in inventory, excuse me, in earnings, and you're not going to have a bunch of foreclosures that drive down price. You're just not. That's why you lost a decade. That's a fact. You're going to
Mhm.
stay there because I don't think there's the urgent group. Think about a third of the people owning the house free and clear, and then on the other two-thirds, a big percentage of them have a mortgage rate under 4. Okay, well, they're good. So you're just not going to get a bunch of inventory showing up that has to sell today, which is a savings grace because you got no business camping out at 16% affordability, but you're going to. But think about the journey to get that back. Play with the math because that's one of the things that report did. Okay, let's go forward 10 years and see where we're at. See if we get labor to go up 5% a year, that type of thing. And it took a long time for you to get to an affordability that you had upside potential for a duration.
That definitely makes sense. I speaking of 10 years out, I actually was thinking a little bit about AI. We were talking about it before the meeting and how you see AI possibly changing or disrupting. I'm kind of curious, Craig, if you're seeing that on the building side of things or what the anticipation is for the building disruption and development disruption with AI coming online.
Yeah, there's a lot of studies on how AI is going to affect the labor market, that type of process. I think we will start to see AI become very prominent in some of the processes and systems and processes that businesses are doing. Whether you're a solo operator, how you're using AI to help streamline your day to make you more efficient as an operator from that perspective, or you're a large scale operator with hundreds of employees. At the end of the day, I think AI will start to come very efficient and useful in that process. But the reality is there's been a lot of studies on robotics and AI in the aspect of the actual construction. And the reality is most of that is I shouldn't say most of everything that's come out so far, while it looks good and functions well, and there is a product that is repeatable, it's not affordable at all. Whether they're laying blocks, whether they're, whatever they're doing, that process of robotics and AI, things like that in the real world settings is just it hasn't proven itself anywhere close to affordable. There's a study done on a new outfit for an actual robot that lays block, and it's the Sam 1000, I believe it was. And they did several studies with that as far as how the affordability of that worked, everything. And they showed that it was about 30% more expensive to use that robot than it was to bring in crews of masons. And that's all because of how long did it take to set the robot up? And this was just in the last 7 months. So this wasn't like this was a robot from 3 years ago or 4 years ago or something that Sean O'Toole and his son were building. And that, this is recent, and they're saying that they're still at currently they're estimating there's still at least 25 to 30 years before they see really any efficiency of labor because of robotics and AI, things like that. Because at the end of the day, just Lisa, just you said, okay, you're in the aspect of flipping. It's hard to take a robot in and go chase out where that pipe is that's got to be busted.
Yeah.
You still need a plumber that can come in and open the walls up and find that and know the best route and the most cost effective route to do that. Same thing with electric. With how do you patch drywall? I mean, there are robots that can do that, but the cost of those robots are upwards of $500,000. Well, okay, if I can get a guy to come in and patch that drywall for $250 trip charge, that's that robot's never cost effective.
I would see it having to be a situation where, if you took a new subdivision and you could develop it from the ground up and you could map it while you're developing it, and you know where everything is, then over time, that cost of ownership, as you send in that robot to make the repair, it would know exactly where to go. It's been there, it's mapped it, everything like that. But existing inventory, I tend to agree with you. It sounds like it's going to be quite a bit of time before we will be at that point where they can go in and troubleshoot and figure out how to do things. And in the meantime, we need more plumbers and electricians.
Oh, well, they've got robots out now that will do interior layouts for you on new construction. So once you've built your walls, then you send this robot in and it does all the interior layout, draws it all out, so that way framers can come in and frame their walls. That robot is currently about $78,000. It says it will lay out an entire, roughly, let's call it a 2,200 square foot house, lays it out in about an hour. Well, I can send my lead framer and a helper in there, and they're laying that out in about 25 minutes. On a bad day, if it's very complex, okay, it's an hour to lay it out. But I mean, let's face it, what I'm paying that framer to be in there at, $100 for him and his labor to go in and lay that house out. That's a lot of houses to lay out before I'm going to go spend $78,000 on a robot. So it's just great technology, a lot of great technology. But when it comes to doing the task of building in one-off settings, it's very, very expensive. Now, you go into industrial markets, whole different ballgame. Once you get into industrial where nothing moves and it's conveyors and everything's running by, that's a whole different process. So I think you could see some great efficiencies coming into play, even with the manufactured homes, modular homes that are coming into play. There's several companies that are looking at doing large custom homes out of modular homes where they're bringing in a cube at a time. Because of the efficiencies of that, I believe you'll start to see a lot of those prices go down.
Over time, for sure, in that market specifically.
Well, you're already starting to see modulars come down. Big difference between manufactured and modular. So on modulars, you're already starting to see a lot of those costs come down because of the speed and efficiency at which those homes can be designed, and in which they can be built in a manufacturing type setting, because they can do so much with robotics that really brings down the cost of that. But at the end of the day, once they go to set those cubes up to build that home, you've still got men out there with cranes doing the work, setting the cubes, hooking up the plumbing, hooking up the electric, those types of things.
Makes sense. That absolutely makes sense. I'm curious to see where this is all going to go. It'll probably happen faster than we think it will happen, but even still, I know we've got some runway on that portion of building, at least in our lifetimes, for sure. I am curious to swap back over to the economy for a little bit. There's noise out there about a recession. There's concern about some of the policies that are in place right now, possibly, the impact tariffs will have, general economic uncertainty, and of course the fear of unemployment. I think that's the big thing that most folks are looking at or watching, and the fact that we haven't quite felt that yet, but there's a sense all around that unemployment is coming, irrespective of AI and the impact of that, just what's happening in the economy right now. How are you shifting your business strategy right now to prepare for this possible downturn? Do you think it will be a large downturn, small downturn, no impact to real estate? What are you thinking at this point? If, given that we've gotten all the goodies up front already, and we've got a whole decade ahead of us to sort of wait this out, how are you positioning your businesses right now to absorb maybe the next 12 months?
So we're actually looking at it very differently. Again, I've been fortunate. I mean, third generation in what I do, but I've been fortunate to have a lot of people that have poured into me in my life, and Bruce is one of those guys. So in learning even further how to really read data and look at that, we've gone back to what we focus on, and that's affordability. How do we beat affordability that other people can't, right? So that becomes into efficiencies based off scale, those types of processes. So the biggest thing to answer your question, Lisa, honestly, we're actually doubling down on it. We're running in and we're running head on into it, because I'm looking out and recognizing that the reality is there's still a crisis that people cannot afford to live in homes. So and Bruce and I've talked about this a lot, as far as, are they going to become homeowners? Or are they going to become renters? How many of them based off of, Bruce and I were talking today. There's a lot of factors at play because now you've got things happening with the economy, but also you've got a section of people that received a diploma and we're thinking, okay, we don't have to pay this back. And now they're saying, oh, wait a minute, we have to start paying this back now. That's a payment we weren't looking for. So there's a lot of things that I believe are going to affect that. And you've also got, Bruce has talked about this a ton in the aspect of the amount of baby boomers that are, on their way out of this world, and that's leaving some, untold trillions of dollars that's about to come into this marketplace because of either what they're leaving to people, but also the amount of real estate that they own, that's got to transfer somewhere, so in that process, there's all of that happening, but there's still an affordability that's being weighed out that people are starting to recognize. Hey, wait a minute, I may not want to live like my mom and dad did maybe I don't want to live in a 4,000 square foot house or 3,000. I want to live in a 1,500 square foot house, and I'd rather take more trips. So we're doubling down in that process and looking for how do we create efficiencies in all the markets that we're in, whether it's things that we're buying in our fund to hold, whether it's product that we're building to sell, all of those components. We're looking at how do we double down on that process. So we're actually, I mean, we're right now we're trying to hire somewhere around 15 to 16 people each month. Now we recognize there's a certain rate of attrition out of that, but that to keep moving and pushing with what we recognize is coming, we've got to stay forward on that. I actually probably look at things a little differently. I don't believe that the tariffs are going to be a long-term process. I mean, if you already look just last month, for the first time in 9.5 years, the Fed had a surplus on their monthly basis of $27 billion. That's tariff income. So there's a lot of things that are coming out of that. And again, I'm not saying that from an aspect of who I vote for or anything like that. I'm simply looking at the economics of the matter that for the first time in 9.5 years, we got a surplus on a monthly basis in our budget. So I believe that we've got I believe there's a lot of different things coming, that there's volatility that people are misreading.
Okay. And Bruce, your thoughts on that volatility and the next 12 months in your mind?
I don't think it's going to be very volatile. I think you're going to have maybe a slow lowering of interest rates, but not down to any ridiculous numbers that we saw before. So let's say you go from 6.5 to 5.25. That'll be a help to the first time buyer for sure. And I think that's where the volume will land. Um, if you have people that are retired with a lot of money, so like the properties that I just sold, half of those got sold to cash buyers. So they're not affected as much either. I don't see it, I just don't see it being a big turmoil, but just think about what's already taken place. One of the things that we talked about in that report was the business of realtors and brokers as far as doing loans. They're going to go down by 40 or 50% in volume. That's a Great Depression right there. That's still in place. So if you're one of those people, your income is definitely not the same as it was because you used up how many refis did they do in the 18 months when interest rates went below 4 to 2.5? When the same person refied 3 or 4 times, and now they're good, so they don't have to refi for the rest of their life. That's that's what happened. We used up a lot of volume. So I'm not real concerned about price declining. I don't see any way foreclosures are going to be a dominant player in what's for sale. And historically, if they're not, then you don't have major price damage. But you do need, if you're going to have price damage, you need a category of urgent sellers. And in Florida right now, it's in the price range that I happen to own in, 500 to 600 grand. There's too many of that house to match with people, what people want. So there's categories that you can end up with too much inventory. So my goal is to sell. I think I have 14 houses left by the end of the year and relax. and come speak once in a while.
That makes sense. What then? Okay, your plan is to relax, right? Relax, not in the because of where the market is, I'm assuming, right? And just say, okay, I'm going to pull back for a minute. Is that the plan, or is it because you personally want to relax?
Yeah, I'm retiring. Craig
Yeah.
is the owner of the Norris Group, and I'll put money in trust deeds with the Norris Group and own my rentals free and clear and enjoy myself.
Very good. Well, you've done many years of work to get to that point, so that's what we're all aspiring to as well. On the rental front, are you seeing any changes in rentals? I'm not sure if you have any rentals here in California anymore, or you sold all of those over time.
Yeah, I sold all of those, but in the Florida, I see here the same thing. So you're, oh my gosh, and I haven't lowered a rent on anything.
Yeah.
So maybe I have the right inventory for that, but I've got to say I raised the rent by probably 55 to 60% in a 2 or 3 year period, and it has stayed. So it went up a lot, but it's camped out there now. It's not going up, but it's fine.
And I'm curious to hear in California, I know the folks who have rentals here, they have been talking about it being a slower market, right? It feels to me like some of the households are contracting, the size is contracting, people are definitely feeling some of the economic pressures right now. And so renting up new units has been difficult, though rents are remaining pretty firm right now, from what I can tell as well. So that's been kind of interesting to see too. And I think for those of us that were around in 2006, 7, 8, starting to see that slowness in the rental market brings back some PTSD of sorts. But it may or may not translate into anything, longer
Okay.
term.
Well, let's talk about that specifically. What was the ratio for closures to closings in 2007 and 8?
Oh, huge. I mean, absolutely huge.
Yeah, like 2/3 of the
Yeah,
closings. Well, that was the comp.
yeah.
So if you owned a house next door that was worth 300 and I bought an REO next door for 70, and I mean, that was the problem. It became worth whatever the REO was because it was the dominant number. So anyway, I just don't see any catastrophes occurring. A lot of it's safe because of the interest rates that are in place and the free and clear stuff that's in place. You're going to have categories of difficulty. So seniors in Florida, let's say there are more seniors in Florida that own 40 houses and they die. And okay, now there's 40 houses times 1,000 people. That's not a joke. You're going to have 40 or 50,000 homes a year show up in a few years that are older homes where the person had died. That'll be a whole category.
That's a huge amount.
Yeah, I already talked to Craig about it, because that's a niche, you know.
Yeah, we've been working with estate firms already starting to put feelers out.
Yeah,
As people go, we're their source.
yeah, absolutely. Put yourself in line and we'll buy this whole shebang.
That's
I
gonna be that's
I
gonna be
think,
quite a number for sure.
yeah. Well, it'll be a great service too, because a lot of people don't want to deal with that.
I think that's what I'm seeing is that real estate feels like, I've been in this about 25 years. Y'all have been in this longer, but it feels like at one point where there, way back in the day, right? A lot less competition, a lot more generic. And what feels like is happening for me in real estate is that um, more niches are appearing, more specific strategies are appearing. The fundamentals still apply across the board, but the opportunities are not slowing down. You just have to look in different places and identify them where they are and how they are and meet them where they are. But they're still there. They're still all over the place. That's what it's feeling like to me.
I don't disagree with that. And also you have to put in perspective that if somebody owns something in California, there's a good chance that they have an enormous amount of equity, an enormous percentage of upside that they have. If they discount something 35% and you take the amount of money they put down on the property, you might be astonished at the yield that they're going to get. I bought a house from a guy like that. He was like, I won't sell you at that price. I said, well, let me show you what your yield is. And he was just blown away. It changed his mind. Yeah, you turned 7 grand into whatever it was, and you figured out per year he was getting 40% a year. And he was just like, oh my God. And it gave him a reason to tell somebody.
Yeah.
So he didn't want to tell anybody what he sold it for, but I can tell you I made 40% a year on my money every year I owned it. Well, now he's a hero. Okay, well, sometimes people get hung up on price and that's not going to solve their problem.
Yeah.
So as a buyer, I try to always find the root of, like, why don't you just list it? I definitely gave people their house back. You call me on my ad, why don't you just list it? You'll net more. I don't want to do that. Well, why not? And that you need to find out the why not. And then all of a sudden you can get in the problem solving business and go, okay, I think you are better off getting rid of it. And there's times that it's a fact.
That's what I was going to say. It's still, the problems are still there. They
That's right.
and they're variations of the same thing. They just maybe appear slightly different. But when you ask the right questions, I think that's what we have to get better at doing in general as investors, is just asking better questions. And I know that's something you've always focused on, and something I've heard you say over and over and over again through the years is ask better questions, ask the right questions, and then solve those problems. And I see that being something that we can do even better moving forward, because people will still have problems. People are still going to be, need to do something with a house or a place that they're living, things
Can
like
I
that.
can I take 2 minutes and tell a story about
Yeah,
that exact scenario?
yeah,
We did our first boot camp where we had 10 people in our office and we were taking live phone calls. And the students were taking the phone calls. And there was a student that talked to a buyer. He had a $140,000 house. He was going to take 120 and nothing less. And eventually they parted company, hung up. And I was just curious, and I was, just listening to it. I said, I don't understand why he was selling it, you know. And so I called him up. I said, I'm the partner of the guy you just talked to. I said, why don't you just list the house and sell it for 140? He said, I don't have time. I said, okay, well, let me save you time. You're not going to sell a full 140 house to an investor for 120. He said, how about 110? I said, no. He said, how about 100? I said, why don't you just list it? You're going to I don't have time. What's the issue with time? I have a chance to buy a $500,000 business for 78 grand. I said, okay, so if I walk over 78 grand today, are we done? He said, yes. Oh, I was a couple questions away,
yeah.
right? And he was better off for saying yes to that. But that's what our business is getting to the bottom of, okay, what is it we're trying to solve? And why don't you do what everyone else, it seems like that would be better outcome. But for him, it wasn't going to be a better outcome. Anyway,
No,
Well,
that's
it's
it. And you said you're one or two questions away each time. That's exactly what it is. Keep asking the questions, keep poking and finding out more, finding out what's out there and learning from amazing people who are in there and doing the work and stuff like that. I think that's amazing. I want to ask, before we get to everybody's questions on the line, again, if you have questions, feel free to send them to me in chat and we'll make sure that they get to Craig and Bruce. I'm curious, I'm fast forwarding out. I will admit this is a little bit on the pessimistic side here, but I'm fast forwarding out 10 years. And I'm trying to think conceptually for myself and thinking, okay, we already have a national debt problem, right? We've got too much national debt. We know that we've got consumer debt, things like that as well. There is much talk about, for right or wrong, about if we do wind up in some kind of financial turmoil, that we're going to wind up printing again, right? The Fed will go back to its old trick and start printing, and that'll raise inflation over time. Possibly higher inflation, possibly higher taxes, everything happening all at the same time AI is coming on board. So I think out about 10 years and I say, I've got to believe that income taxes will be higher. I've got to believe that um, uh, inflation will be higher. Who knows what will happen with the debt crisis unless we're willing to address it at this point. But this is kind of where I see things happening at the same time. Maybe jobs are coming offline and we haven't quite hit the revolution sweet spot yet on all of that. I think about where we might be as a country, where we might be, from a housing perspective, where people might be financially. And I just kind of, it's an exercise in a crystal ball to think about where we could be and how different 5 to 10 years is going to be for us with the factors we have going into this next 5 to 10 years. I just wanted to know your thoughts on that, pure speculation.
Okay, you want me to go first? I
Yeah,
think
I want to hear both of you.
I'll be honest with you. I think it's past my pay grade. I'm concerned because do you know who Ray Dalio is? Okay, Ray Dalio is a really smart man. Now, I studied 50 years of real estate stats. He studied 500 years of history about
History.
how countries lose the world currency
Yeah,
and wrote a book and very specific about how the process is. And he feels like we're in the ninth inning. That bothers me. That really does. So I don't know how that plays out. I don't see, you know, I think about the United States and being trusted that the US dollar, what's the reserve currency that's trusted? Would it be the China currency? That doesn't make any sense to me. I don't even know what Bitcoin is. I don't want to own I don't want to own something I can't hold, and I know I have to get past that maybe, but in other words, I don't know what the answer is. Maybe we improve something about the United States, like we're the best solution there is type thing. And that may be, but honestly, I think this is past my pay grade and I study about it a lot.
that's why I asked. I'm curious, Craig. What are you thinking? These are the things that keep me up at night. I think about all this crazy stuff.
Yeah, I would agree with Bruce. But I think that there's probably more in the way of what's going on in the next 2 years, 5 years before we're ever at a 10-year mark. I think there's a lot of triggers that could happen one way or the other that send our country uh, towards a positive or towards a negative. I mean, I think there's a lot of things fiscally that we've got to be very responsible for. I don't think it just means lowering taxes or raising taxes. I think there's a lot of policy procedures that need to be looked at, and I hope as a country that and as a people that we really look at who do we put into office. And again, I'm not making that statement for one side or the other, but I believe that there's we're close with what's going on with global economies right now. Like Bruce is talking about, why is the dollar still the gold standard right now? I mean, there's not a lot there. So if we're going to sustain as a country, we've got to get our debt under control. We've got to manage how much we spend. I mean, we're as a country, we were basically greased there for a while. We spent without regard for what we were spending on and how we were going to pay for it. So I think that's a big thing. But to make a statement, I'll make a statement about a lot of things, but what 10 years from now looks like, I think that's above my pay grade on that.
Well, I appreciate you guys hypothesizing anyway, for sure. I think more than anything, we need some political will. And that's directed at both sides of the aisle right now because we need political will to make those changes that we need, that we know we need, right? And I think there's just personally, I feel like there's too much finger pointing and not enough progress. And we've got to make some progress on these issues that we have. And uh, pretending that we don't have a healthcare problem and pretending we don't have a debt problem and then pretending and pretending isn't getting us anywhere. And I just think I'd like to see some positive change made. And I don't know if the last 10 years have been anything like the next 10. I don't know. It won't be too great, in my opinion. All right, let's go ahead and take some questions on hopefully a more optimistic tone. Andy asks, will I guess this is open to Bruce or to Craig. Will you either of you be able to touch on proposed legislation to eliminate Florida property taxes and potential impacts to landlords and homeowners?
Um, yeah, that's interesting. Craig, is that for people that have rentals or just people that have occupancy of a home?
No, it's not just about a homestead. It's property owners as a whole.
Okay, that's a lot of revenue to dismiss.
Yep.
It's got to be replaced by something. What's it going to be replaced by? I'm just curious.
They're what they're talking about right now in the Senate is they're talking about an increase on the sales tax.
Okay, wow, that's interesting. I wish they just raised tax on stuff I don't use, like liquor or something.
So, but yeah, no, that's where they're at. I mean, there's a lot of things that they're talking about within that realm as far as if it's going to be, can it be wiped away? Can we afford to wipe it away? Is it going to be some sort of tiered system? Is it a sliding scale that's lessening the tax value? Is it just a lowering of a tax value? So there's a lot of things that are being looked at to see how do they make that work.
Okay.
Interesting. Okay. David asked the question. Well, he wanted clarification from you, Bruce. So he heard you say, back to your report, 1% or a lost decade, right? With respect to your last report title. He said, he's clarifying that you're thinking that California real estate prices are not going to increase. They're going to kind of remain flat for the foreseeable future, right? And then that's why you're discussing that California feels dead or will be dead for a while. All right.
Yes, yes. Your affordability number is at a historic low, and you just don't recover from that because the will of the buyer, he's discouraged. That's why you don't have multiple offers. If you do, it's an unusual circumstance. You get to 16% initially by multiple buyers making offers and offers and getting it there, but you've been camped out there for what, 2+ years?
Mm-hmm.
You're just sort of stuck. You're not going to have foreclosures lower it, lower the price so the affordability goes up. So you don't have that advantage. You have to grind this out with higher earnings and gradually lower rates. That's the only way. And it's going to be very slow. And you're not going to initiate a bunch of multiple offers just because you get to 19 or 22. You're just not. So, I mean, you got to be thankful if you were a participant in that run where you got your number changed on your rent from 2 grand to 3,500 or your value from 300 to 500. Man, give your house a hug.
and
That's
and plan to sit on it for a minute.
that's right.
Okay. His second question here is I think I might need some clarification on this, David. He's saying foreign investors, especially foreign land investors, any thoughts on where that might go? That was his question.
I think they're going to be restricted on that, which would be a really good idea. I think the farmland is one of the issues. And I think that's a really good idea not to have somebody in another country control our ability to grow things. Yeah, I'd be all for that.
Okay. Andy asked a follow-up. He was the one that asked a minute ago about the property taxes and in Florida specifically. And he's saying, so do you think this might impact housing prices in Florida?
Well, I mean, I just think about that. If I'm a renter and I don't get those goodies, I'll buy a Craig Evans home pretty quickly. Because what would that reduce the monthly payment if I'm not paying property taxes on a 400 grand house,
Yeah, you're dropping $420 a month.
right?
That's a big
So
number.
that would not be a hard decision. It wouldn't be a hard decision to have somebody migrate here if that was the story and it wasn't the story in the state they were in.
Well,
Absolutely.
you take that and then you've got, like just for Florida right now. I mean, because I know there's like let's talk about insurance. That's a whole different animal between what's happening in Florida versus what's now happening in California. You guys are starting to see, insurance companies exit California, and you're experiencing the same thing that we experienced after Hurricane Ian. We had everybody and the brother ran for the hills because all of a sudden, they wanted to get out of it. And we had a couple of years of really tough insurance processes. Citizens just this year, had their first lowering, which Citizens is our state, the kind of the last resort insurance company. We just had our first decrease in insurance rates in 4 years. We've had 14 new companies come in and start writing in the state of Florida.
Oh,
So,
wow.
so you have that, and all of a sudden potential for property taxes going down starts to get potentially very, very attractive in the state of Florida.
You
That,
better
I mean, that's a
option some.
huge, the going back to the PITI, right? That's a huge impact
Oh yeah,
related.
That's
yeah.
it.
I'd be buying one of those houses too. Um, David
Well,
asked
we have investment properties.
David asked another question. Do you think there is going to be a significant correction to prices in homes and condos less than $1 million? Now, that's an interesting question. I also wanted to tag on a second part of that. I recently read a news article that said because of that condo collapse in Florida, specifically in that area, they were talking about adding or making it available for homeowners associations to take on debt. I heard that through the HOAs, and I think there was something to the effect like the homeowners didn't have to agree or something like that. It was just they could take on some debt possibly to make the needed repairs and whatnot. So there was a concern in the article I read regarding the value or the continued valuation on some condo buildings because they would obviously be less desirable now that that might be an option. But David's question is also asking, if we think there's just in general going to be a correction in homes and condos less than $1 million.
Okay, so to answer that question, you have to understand what causes price damage. So is it interest rates going up? Okay, 74 to 80, interest rates doubled, prices tripled. So that's not the clue. So let's land in 1980 for just a minute because this is when you do this research and you see these combination of charts and then the result, it really gives you your head is like, how could that happen? 1980, you have 10% unemployment. Um, you know how many months of inventory you had? We're upset at 4, at 20. 10% unemployment, 20 months of inventory, foreclosures up where they were 1 in 4 sales. And how much price damage? None. So you could have interest rates be at the crazy rate and have 20 months of inventory. The inventory wasn't enough of urgent inventory, have to sell, has to be an REO, that type of thing. And okay, no price damage with all those negative things. Go to 89 to 96. You have that little cycle there where all of a sudden foreclosures grew a little at a time until it got to about 35%. And gradually you had about a 12% price hit during that journey. We all know what happens in 2008. Well, in 2008, you had a crash of almost 50% in California prices. How much inventory you have? Do you have 20 months? No.
No.
You had about 8. And interest rates weren't 15. They were what, 5 or 4? And you had a crash in price. The significant category is urgent to sell inventory. It has to be sold. Where is it? It isn't, it doesn't exist. That's the answer. If you don't have that category, you can't crash.
We don't have that category in
You,
California or elsewhere right now.
no, you don't.
No, don't see it. I mean, we do see bankruptcies rising. We do see people having more financial distress, but there's quite a few tailwinds that are also supporting that. And to your point, the options for moving, they can stay put. People can stay put. So things would have to take a much more dramatic turn for the number of foreclosures to be happening or that urgent need to sell. And I'm not seeing it either right
Well,
now.
just think about, there's a safe level at 25% of the market being foreclosures, and you're less than 1%. It means your foreclosures could go up by 25 multiples, and you're still okay
Still
historically.
going to be okay. Yeah, yeah. Yeah, we're seeing very few of them. Few more auctions, few more things out there, but no one seems to be very urgent. I would say you do hear, I think what I'm seeing on the market or just feeling a lot because of things that come across my desk every day and anecdotes in the field is more along the lines of there is a lot of urgency to sell right now, but the urgency is not necessarily because of financial stress. It's more because of perception. They put the house on the market, it didn't sell in one day.
That's
And so
right.
they've been on the market 30 days and their hair is on fire.
Yeah,
And so now they think they've got to do something to eliminate this house quickly because, the expectation of that fast sale is really ingrained in everybody's mind right now. And so you are seeing people who are jumping into extreme measures quickly, not for any other reason except they just can't handle sitting on the market for 30 or 60 or a normal amount of time that was historic before the past decade, right? So
right. And
quite
even if
interesting.
they sold it at a discount, it wouldn't harm the market. It would be a lower comp, and maybe there would have to be some other lower comps before you got a lower value. But okay, what were houses worth, 6 years ago? Didn't prices pretty much double?
Yeah.
Okay, so whoever's selling that house is doing just fine and not destroying the market. So there's no combination of charts that you could have right now that I see, unless there's a disaster coming up that I don't see. I don't see the price damage. It can't materialize with the charts that we have right now.
Okay, that's good to know. Another quick question here from Matt. With the possibility of the Federal Reserve lowering short-term rates later this year into next year, do you think long-term rates will come down or stay where they are, um, due to the Treasury having to continue selling record amounts of bonds to finance the ongoing deficit?
I think the rates will probably come down, and I think it'll probably have very little impact on prices. I think it'll affect the first-time buyer market to where they'll want in. So let's go do the math. Let's say more of your state is now represented by the first-time buyer. You'll show a median price decline, but it's just that you sold inventory in different ratios. I don't think you're going to have a big price decline, and I don't think you're going to have a big price increase when you have interest rate go down. All that's going to do is change your affordability from 16 to 19. If you take a look at a chart when that occurs, oh no, that's not what you do.
I'm kidding.
No, but what I'm saying is the first 2 years that affordability goes up, no other charts do well. Doesn't improve a thing. Never has in the last 50 years. Sounds like it should, but it doesn't. And
Bad
why is
news
that?
all around.
Yeah, why is that? The mood of the participant is changed. I don't really want one.
Good news for investors.
Yeah, that's right.
We like that a little bit. On your first time homebuyer comment that you just made there, one of the questions I did want to ask you, Fannie Freddie privatization. I know that President Trump has talked about that as being one of the moves he might make. Your thoughts on that and how it will affect the first time homebuyers, especially in the current market we're in right now.
I don't know that I have any response to that. I don't think I have enough experience with that. I know that we're going to get to interview the past um, CEO, or not CEO, help me
Chief,
out, Craig.
Chief
Chief,
economist.
chief economist at our Nixon Library event, and I'm sure he'll have a very educated opinion on that. But you know, I was in Washington D.C. just shortly after it went out from being private ownership. So that's kind of all I've known since I've been connected to them.
Full circle moment, right?
Yeah.
Potentially. We don't know. We don't know. I mean, I've seen some papers written on it, and it sounds like it will definitely, possibly make it more difficult for first-time homeowners to qualify. Um, and so I wonder how that would impact the ability to buy that affordable housing or a Craig Evans home or something like that, and if the idea is to limit home ownership, right? We're already in an affordability pinch, and uh, it, I guess the policy would drive possibly less home ownership at that point. How that might impact things overall, or just the inventory out there, or possibly ease the housing shortage, that we're seeing. I don't know. The more to be determined on that.
Yeah, just me personally, I think that's a really terrible direction for the
Yeah,
country to go. Absolutely, honestly, because I'm just speaking as a guy that got married at 17 and didn't own a house till I was 20. That was a big deal to me. That was a very big deal to me. And I write the California crash report saying prices could go down by, 50%. Do I sell my residence? Gave it a thought. Actually called a guy that had a pretty cool rental. You know what he asked me? He says, I told him, I'm not your normal renter. I'll pay a year in advance. He said, that sounds wonderful. He said, can I ask you a question? I said, go ahead. He said, do you have any pets? And there was a pause, and I was like, I'm so grateful you asked me that. That's why I own a house, so no one gets to ask me that. I sold that house instead of at 1.5 million for 750, and I could care less because I got to cut my own lawn. I hope that attitude returns to America. I really do, and I hope there's a lender that goes along with that because that helps people financially. When you ultimately own your house free and clear, holy cow, that's a big day.
The big
Your biggest bill isn't there anymore, and that you can be entrepreneurial, or you can get it paid off really quick. Sometimes you go in cycles and you buy two, and when one doubles, you sell it and pay your house off. Like, oh my God. Anyway,
yeah, I think Lisa, with the Fed dumping a lot of the stuff that they've had on their balance sheet, and trying to clean that off from some of the loans that they've had on there. I think if they can keep doing that at a steady rate, I honestly believe within the next year and a half, that could stabilize a lot of what's going on that balance sheet perspective. So I would be very surprised if they went back and privatized that. If they keep going and pulling off the bad debt that they've got on there that they took on back in 9, 10, and 11, and get a lot of that off, that'll clean a lot of that balance sheet up from Fannie Mae, Freddie Mac, and just the Fed as a whole on the balance sheet portfolio they own. I think that'll clean a lot of that. I would be very surprised if they went back to privatizing it.
I
well,
get
I'm
the
just curious.
impression.
Let
Sorry,
me.
I get the impression it's a little less about cleaning up a healthy balance sheet versus a windfall for somebody else. That's what I kind of surmise from the whole thing, but
Okay.
there could be two portions of it.
Okay.
All right. Question from David. If you had 250 to $500,000 right now, where are you investing? And I'm going to add on to that with a second question that I have here regarding where are the hot markets right now for investors? Hot meaning stable regional economies with appreciation potential, positive cash flow with 30% down. Buy and hold, not flipping.
Okay.
So I'll tell you, I mean, obviously we own an equity fund, right? We've got $100 million private equity fund. I'm very careful in that process because I don't ever invest for appreciation. If appreciation is one of the major processes that we're looking at, to me that's way too risky of what I'm looking at. I've got to make sure that the deals make sense before appreciation comes into play. So I'm looking at them from, again, I'm going back to a basis. What are we buying for? What are we putting in it? To me, I don't ever invest in anything via my businesses, via, we with other people's money. I'm a fiduciary. Our fund is SEC regulated. I'm a fiduciary for that. I don't invest based off appreciation. We invest based off Does the deal make sense, and will it cash flow? Does it generate revenues in the here and now? And then we do look at depreciation. What kind of taxable events can we wipe away? But for us, appreciation is always icing on the cake.
So what are those markets right now you're looking in? Or you mentioned that you're in Florida and in other markets as well. Are there some top markets that you are looking at or could recommend?
Yeah, we're there's several places in Georgia that we're looking at. There's 2 spots in Tennessee that we're looking at. Got a good deal that we're looking at in Pennsylvania on some multifamily there. So I like the Sun Belt. I like what that does. I mean, obviously, I know Pennsylvania is not in the Sun Belt, but I like what's going on in the Sun Belt with the amount of infrastructure that's being built, the amount of business that's coming into the Sun Belt area as a whole. That there's a ton of business that is coming into this market that is driving jobs. And at the end of the day, people that are coming for jobs need places to live.
Love it. And they're high paying jobs and the workforce is there.
Yeah. I mean, Greenville, South Carolina is just it's a hot spot. Charleston, South Carolina, there's some areas. Charleston has had a good run. It's plateauing a little bit, but there's still some areas on the outskirts of Charleston where you can still get really good buys and cap rates are still staying strong. A couple areas in Tennessee, outskirts of Nashville. Nashville is seeing just a massive boom right now of stuff going on, but there's some outskirts. You get 25, 30 minutes outside of Nashville. There's really good things happening there. But then there's some smaller markets, even in Tennessee. You can go on the outskirts of Chattanooga. There's good stuff there with some of the industry that's coming there. So that's what we look for. We look for boring basics that when we're going, we want to make sure what are the jobs look like? What does the housing industry look like? How stable is it? What do the schools look like? We just go back to what are the basics of fundamentals look like that we're trying to invest in.
Always back to the fundamentals never steer you wrong. Anything, all the noise could be going on in the marketplace, and I love that you said that, Craig, because you're right. If you just stick with your investing fundamentals and don't get swept up in speculation and appreciation, there's always an upside for you with respect to that. Last question I have, and then we're going to wrap up for the evening because I know that it's late and we've already kept you a little overtime. I know you're mainly multifamily or single family guys, and I wanted to kind of get your thoughts on multifamily versus single family versus multifamily in terms of kind of how you're looking at it, Craig, from an investment perspective, given affordability, given rising costs, given rising everything that, I'm seeing a big I guess I'm hearing a lot of people make more noise about the safety of multifamily versus single family. And, as a builder of single family, some of that rings true. Your roof is more expensive, this, you've got all these factors that are kind of pressing against you. So what are your thoughts on that as you're looking at these other markets?
Well, from an aspect of being able to create a product, multifamily is much more affordable per square foot to be able to build than is single family. Once you get over 4 doors and you've committed to saying, okay, we're going to take on the commercial processes of, fire suppression and all the stuff that has to happen at that point, it is much more affordable to build multifamily. But you gotta know that market. You gotta understand what that's about compared to single family. Single family is, I think, to a degree, can be easier because you've got people that are looking for. You've always got people that are looking for single family homes. You're typically going to get a higher rent out of a single family than you are out of an apartment. But again, that can depend on the market. We've actually got a apartment complex that we're looking at buying here for our fund. It's about 218 doors. But if we buy it, what we're looking at, we would end up buying that really, really good. We'd be at about a 34% equity position on it and still turn about a 7.8 cap rate on it. So it's just looking at where you're buying on that, but from an affordability perspective, that is definitely the best aspect to be able to gain that, because your basis on your land, you're building vertical versus building horizontal. And anytime you can build vertically, your cost to build and cost to construct goes down. So that's definitely a benefit, but there's financing games that you got to understand on how to manage financing in multifamily. There's a lot of people that are losing their lunch in multifamily because they just don't understand how to deal with finance.
Yeah.
And that's a whole different game. You may go through in a true construction phase of multifamily, you may go through three different finance products before you're exiting that and stabilizing that product. So it's just understanding how to work through those to make the financing work the best for you.
I definitely appreciate that, because it is there, the complexities are real, and if vacancies are high or you have trouble filling it, there's going to be some challenges as you work your way through the maze of financing, for sure. So I
Well,
appreciate
and Lisa, just to, like in that, even in this market, with the latest thing that came out from MSN and everybody talking about we're the worst place, right? When you look at the amount of apartments and multifamily that's here, they're saying our vacancy rate is around 85, 80, I'm sorry, occupancy rate's about 85, 86%. Well, that's true, but also when you take on take into the account the amount of doors in the last 12 months that's came onto the market, that's added to that. So when you actually look at the lease up rate of multifamily in Lee County right now, it's through the roof.
that.
We're seeing lease ups at a phenomenal rate. But the picture, as Bruce was talking about, people get caught up in percentages. They just want to talk about percentages versus what does that really mean, right? And so while saying, hey, we've got 15, 16% vacancy rate here, well, it's not really real in the apartment world and multifamily world, because there's been so many doors that just came on the market in the last 12 months. So it's a misconception of what's really there. So that's one of the things when you're getting into multifamily, you've got to know what that market is holding and what the demand is coming from. It takes time to do your due diligence on it.
What's coming online, for sure, for sure. All right, last word tonight goes to Bruce. And Bruce, as you're kind of on the eve of retirement, I wanted to ask you if you had any advice for investors, that things you've learned or wisdom you've learned from over the years that you would like to share, about how anything that kind of encapsulates your whole investing journey, and
Okay,
what you
I
can share
can
with us.
I can do that in one story. I worked for a company for 3 months. That was the beginning of me getting into the flipping business. And I didn't like how they treated people, so I went out on my own. And I didn't know a lot. But within a month, I had an experience with a seller that would change my life. I went to hear Jim Rohn speak, and then he recommended Og Mandino, who wrote a book, The Greatest Miracle in the World. So I sat down and talked with this seller, and I had never sat across from a seller that had acted the way this guy acted. It was so like he was like almost not even there. So this is why I can pay for your house. That's fine. And I need a 30-day escrow. That's fine. And I need you to clean up some of the stuff. That's fine. And it bothered me to the extent, honestly, my hair on my neck, I just felt like I'm sitting in front of somebody that's going to kill himself. That was my thought. And so I said, you know what? I don't want to talk about your house anymore. I said, are you okay? He said, no, no, I'm really not. And I said, okay. So I said, I don't want to talk to you about your house. I'm going to go. And I had bought 10 of these books to give them out. So I gave away Og Mandino's book to the guy. I said, I'll talk to you in the morning. I want you to read chapter 9, called the God Memorandum. And it's basically a chapter that says, you may have forgotten this, but you're the greatest thing since sliced bread. And I went back at 8 o'clock in the morning, knocked on the door, and he opened the door. He said, I want you to know that the book that you gave me saved my life. I was going to sell you my house and kill myself. And like you said, I've had a lot of transactions. Never once did I look at somebody as a seller first. I looked at them as a person. And it has allowed me to communicate them in an honest way, just because that's what I was looking for. I was looking, say, okay, I want to do a deal, but I want to make sure you're okay, because sometimes people aren't. So keep that in mind, when you're dealing with somebody, look across the table and see a person and do the right thing before for the profit motive. That's what I took away from that business. And it changed my enjoyment of the business. It really did. Because I can't tell you how that changed it, because I knew what I was going to do. I was going to do, believe it or not, you can do what's best for somebody and buy a house at a discount. That's a really weird thing to figure out, but I figured it out really quick. And you know what he said to me after that? He said, I am going to sell you my house. What I decided was I needed a new start. And I went from trying to steal some homes to giving people new starts. I mean, what a gift. That's what we do. We give people new starts.
That's beautiful. That's beautiful. Thank you, Bruce, for all your many years of wisdom and for sharing that with us and staying up late. And Craig, for joining us for the first time here at LA South Rio. We really appreciate your time and your wisdom and the knowledge that you have to share with us. And hopefully we will take away some of this great learnings from here and look forward to seeing you in September and then beyond if you're going to do another report. We're excited about that as well. So
Okay.
thank you, gentlemen, for being with us tonight. We really, really appreciate it. And thank
Thanks,
you.
Good night,
Lisa.
everybody. That was great. Thank you.
Have a